Everybody, I want to talk about a company called VICI Properties, which is one of my favorite real estate stocks to buy right now. It's on the top of my watch list as I get ready to buy some stocks in the beginning of June. And before we get started, please take a minute to click subscribe to my channel if you don't already. And take a look at the link you see on your screen right now, fool.com/Frankel, where you can get the top 10 stocks to buy right now from my sponsor, the Motley Fool. So, VICI Properties is the simple way to describe it is as the casino REIT. It's a real estate investment trust that primarily focuses on gaming properties. It was a spinoff of Caesars Entertainment. It completed its IPO in early 2018. And as you might expect, Caesars is one of its biggest tenants. It owns the real estate of Caesars Palace in Las Vegas. It owns Harrah's Las Vegas, which was its first property, and it owns a portfolio of regional gaming properties as well. Caesars Atlantic City is an example of a Caesars occupied property it owns in a regional destination. It has grown dramatically through acquisitions since going public. It acquired its chief rival, MGM Growth Properties, which spun out of MGM Resorts. It acquired them last year. That brought properties like the MGM Grand, the Mandalay Bay, Excalibur, and a few others on the Las Vegas Strip. And it also separately acquired the Venetian Resort and Convention Center, which is the biggest convention space that's directly in the heart of the Las Vegas Strip, the Sands Expo Center. So it is the biggest real estate owner on the Las Vegas Strip. It is the second largest net lease REIT of any kind in the world. Realty Income is number one, also a favorite of mine. And the company owns a total of 50 properties leased to 11 different tenants. I mentioned Caesars is a big tenant of theirs. MGM is as well from that acquisition, the Venetian, but they also have a few others that are very popular in the gaming space, as you can see right there. And a net lease is a special type of lease structure that requires the tenants to pay insurance, taxes, and most maintenance costs, essentially getting rid of the variable costs of property ownership. And they generally have long-term leases, and that's an extreme truth in Vici's case. The average lease it has 42 years remaining on its term. Talk about visibility into future cash flow. Over 90% of leases are guaranteed by their operators. So, in other words, Caesars guarantees the lease on a corporate level. It's not just a property level lease. So that gives it a nice level of protection. And for further proof, Vici is one of the very few REITs that maintained a 100% rent collection rate throughout the COVID pandemic. That was very rare in the real estate space if you follow it. What's more, not only are its leases long, 42 years is the average length, they all have they have annual rent increases, which are known as escalators built right in. Not only that, but they are also inflation protected, which is a big thing today. That's a big negative for a lot of net lease REITs. About half of Vici's leases are CPI linked today, and nearly all of them, 96%, by 2035 will have CPI linked escalators in there. So it's an inflation protected, predictable stream of income backed by some of the best operators in the gaming industry, which the gaming industry is doing fantastically well right now, if you're not familiar. Um, and I mentioned the company rose through acquisition primarily. It has a great track record of not only growing through acquisition, but doing it in a way that adds value for shareholders. Over the past year, just looking at its first quarter earnings, Vici's revenue more than doubled. Now, usually when a company grows that fast, it's not apparent in the company's earnings per share, or it makes it take on a lot of debt. Vici maintains an investment grade balance sheet, and it increased its funds from operation, which is the real estate version of earnings, by 20% year over year in the first quarter. That's a high rate of growth for a REIT. And it shows that they are making these acquisitions in a responsible and accretive way for shareholders. So, what's it doing now? Obviously, it's not a great time to be buying a lot of commercial real estate right now. Interest rates have risen, cost of capital has risen as well, and there's a lot of uncertainty in the space. Vici's still finding ways to put money to work. It recently announced the deal to buy 4 Canadian gaming properties. And one of the most interesting things they're doing lately is they've started investing in some financing deals. not buying property, but loaning money to operators to finance. Think of it this way: if you're an investment grade credit rated company with billions of dollars of financial flexibility, an opportunity is to be had when interest rates rise and you can borrow money cheaper than the people who want to build properties. Just for example, Vici recently agreed to make a total of four separate construction loans to Great Wolf Resorts. They make the indoor water park resorts that kids love. My kids love them. They are financing those. So, in most REITs are kind of slowing down their investment strategy in the current interest rate environment. No one can blame them. It's expensive to borrow money to build and acquire properties. Vici has figured out a way to take advantage of the rising interest rate environment in a way that's going to benefit its shareholders. I really love that move. I mentioned investment grade balance sheet, so I'm not really worried about that. In the future, the company wants to diversify its portfolio beyond gaming. It wants to stick with experiential REIT or experiential real estate, rather, meaning properties that people have to go to that sell services, not products. Gaming is one example, but there are others like water parks. I mentioned Great Wolf Resorts. Um, you think of like a Top Golf. There's golf attractions are examples of experiential properties, amusement parks, museums, things like that. So there's a big investable universe. They're just starting to diversify outside of the U.S., which they see as a big opportunity. And it's just it's been a short track record so far. They've only been public for a little over 5 years, but the track record has been very impressive so far. Let me put some numbers behind that. Not only was Vici the best performing real estate stock in the S&P 500 over the past year by a significant margin, it more than doubled the S&P 500's total return since it went public. It's produced a total return of 123% for investors. That's compared to about 60% for the S&P 500 since February 2018 when it made its public debut. That's a pretty impressive track record. It has raised its dividend every year so far and plans to keep doing so. It pays a 5.1% dividend yield right now, so it's a pretty high dividend stock. And it's been kind of rare in the past year or so, but this company is now on sale. Its stock is down about 15% from its recent highs due to general interest rate and economic headwinds, really nothing to do with the business itself. And it trades for less than 15 times funds from operation or FFO, again, real estate version of earnings, which is a pretty low valuation for a company with this much visibility into its into its future cash flow. So I'm seriously considering making a pretty good size investment in Vici when it comes time for my June investment round. I'd love to hear what you think. Please leave me any comments. I will do my best to answer each and every one of them. And thanks for listening. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.